Are you broke, or despite earning decently, you can't understand where your money's going? That means you're in a mess. And yeah, we know COVID's hit you hard. We all suffered that fate. However, if you knew proper money management, perhaps you could figure a way out. So what now? How do we get out of this financial mess? Don't worry, we're going to tell you. Hey everyone, welcome to the channel. Here we preach positivity and to try and make your lives better. So if you've not subscribed yet, hit that red button, press the bell icon so you never miss another update from us. Without further ado, let's start into 10 ways that you can fix your financials. Number 10, analyze. You must be aware of your position. Only then can you formulate specific objectives for paying off your debt and developing a workable budget. Even if you're carrying a substantial amount of debt, you'll feel at least a little bit of control through the information you get after a proper analysis. Finding the underlying problems that are producing the challenging financial position is the first step in solving any financial challenge. First, watch out for these indicators. You have continuing debts like personal loans, large credit bills, unpaid utility bills, etc. You live paycheck to paycheck, your investments are performing poorly, your savings are inconsistent, and you don't have an emergency fund to fall back on. This will assist you in determining the cause or the causes of your debt burden as well as its effects. You see, pinpointing the root reasons for your financial issues is crucial, since it increases the likelihood that you'll find a precise and long-lasting remedy. Number 9, prioritize your goals. You must comprehend what you truly want in the short and long term before you can create a budget and begin your plan. For instance, in 1, 5, 10, and 20 years, where do you want to be? What level of wealth do you wish to have? What possessions do you desire? How would you describe your family, your career, and your personal lives? What aspects of your present life do you wish to change? Don't worry if you find these questions scary, or if you don't know the answers. The goal of the exercise is to begin thinking about your life so that you're better prepared to start creating a plan, not plan out your entire life. Number 8, pay off unpaid debts. The debt problem should be your first and foremost area of action once you've examined your balance sheet and discover that it's problematic. If you're paying more than 40% of your monthly earnings on debt repayments, this is a strong sign. Investors frequently ask if they should invest their surplus money, if they have one, whether they should use it to pay down existing debts. And in 90% of cases, the solution is to pay off the debts. It's essentially coming down to choosing between the potential post-tax earnings from your assets versus the post-tax expenses of holding debt. When it comes to practically all consumer-oriented debt, such as credit debt, auto loans, durable good EMIs, etc., the interest rate is typically so high that no rational investment can outperform it. Paying off debt is the first step to lowering your debt-to-income ratio if it's greater than 40%. This could be achieved by reducing your spend or unnecessary spend or selling off assets. The only good loan that comes to mind is a mortgage because the interest rate is typically acceptable and both principal and interest payments are tax deductible, which allows you to lower your overall cost after taxes. The cost of home debt may be exceeded by a long-term equity portfolio as well. Number 7, budgeting. How will you manage your finances if you aren't aware of your cash flows? You must therefore perform a budgeting exercise that considers your spending habits. This will enable you to manage your spending appropriately. Setting up a budget is like turning on the lights in a dark room. As you diligently comb through bank or credit card bills and track expenses, it'll help you make better financial decisions. You'll understand how to manage your finances so that you may eliminate wasteful spending and fix your financial situation. You should periodically review your budget and make any required adjustments. Create a corpus for an emergency fund that can cover 12 to 24 months worth of expenditures, expenses, and loans to withstand a disaster. Keep a reserve so that you can cover unforeseen costs without incurring debt or putting yourself in a bad situation. Number 6, your emergency fund. You'll hear this advice to create an emergency fund from every financial counselor. If you lose your income, you should have at least 3 to 6 months worth of costs covered by this fund. Saving that much money may seem unattainable if you have a lot of debt. However, you should start small by making even a small amount of savings. Start by putting $5 into your piggy bank or savings account each week. To keep track of savings, include it as an expense on your cash flow worksheets. As you gain familiarity, you can gradually increase this amount to $10, $20, and so on. If you're finding it difficult, consider the ways you might cut costs to be able to save. Consider what you can live without and what you truly like. It's important to continue doing some of the things that make you happy. Don't torment yourself. Your mental health will start to deteriorate if you deprive yourself excessively, and you might say that kind of defeats the point of everything. Start by determining which expenses you can reduce without feeling miserable. To save a little more money, look for discounted versions of your favorite products. These subscriptions and memberships you don't need, go ahead and cancel them or put them on hold. Consider skill and service exchanges with individuals you know, such as getting a haircut in return for watching pets. Instead of using an Uber or driving your car and spending on petrol, consider taking a walk or a bicycle trip. You'll also benefit from some energizing workouts. Sell some items you have lying around that you hardly ever use. All of us have those. Just look around. Number 5, purchase insurance. After creating a balance sheet, insurance should be the next area of emphasis. The first piece of advice is to remember that insurance is not an investment. Although there are many insurance investment products available, the returns on these investments are typically rather poor. The majority of the time, investors are better off purchasing pure protection policies and managing their investments separately. You should at the very least think about getting life insurance and medical insurance. Number 4, asset allocation. The only thing left after paying for insurance and debts is your investable surplus. This is the sum of your assets plus your monthly surplus savings. You can invest up to this amount to meet your financial objectives. Be specific about your investment objectives. Set a time duration for your investments. Establishing an asset allocation for each of your goals is the next stage. The general guideline here is that even if there may be ups and downs in any one year, you can invest in riskier assets like equities for goals that are very ambitious, because these assets also offer higher expected returns. Similar to this, it's preferable to invest in safer assets, such as debt, to increase your chance of seeing good returns through the investment. While everyone has their own particular goals, there are 2 that are most common that you must consider: your emergency fund and a retirement plan. Number 3, utilize additional income. Given the unstable state of the world today, having a second or additional source of income is essential for anybody. You can make extra money in several ways, including monetizing your interests, turning your hobbies into businesses, consulting or freelancing, or even taking on a second job. Even while the money from various sources may appear negligible in comparison to a principal fixed income source, over time even tiny sums might add up to something big. With this increased income, you can expand your assets rather than prepay loans, credit card dues, etc., or shorten the interest or duration. Having additional revenue sources can also help with support costs and financial stress. Number 2, get professional help. If you're not happy with your debt reduction progress, you might want to look for assistance from reputable organizations. Financial consultants can also assist if you need advice on long-term objectives like retirement or education savings. Finally, your friends and relatives may be able to help. Just be sure to establish clear expectations and boundaries to preserve such bonds. Number 1, pay attention and be consistent. To get out of your financial mess, you must maintain concentration. Look for ways to save money, reduce expenses, and lead a thrifty lifestyle. You only need to consider how to use savings to get back on your feet financially. You must also monitor your progress towards your new objectives and the degree of financial discipline. This video might excite you, but when the excitement wears off, it's your consistency that makes you successful. And that's been it. If you have any other tips to maintain finances, feel free to drop them in the comments below. Consider subscribing to the channel and make sure you hit the like button if you enjoyed today's video. See you on the next one.